you're listening to this and you're a business owner and an investor, you do need access to operating capital, right? So you have to have some sort of a diversification strategy.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to another episode of Wealth Strategy Secrets. Today we are joined by return guest, MC Laubscher. MC is a husband, dad, entrepreneur, investor, and educator. As an educator, MC's passion is to share how investors and business owners can create, recover, warehouse, and multiply cash flow through advanced cash flow strategies. Having figured out how to escape the rat race and replace his income through cash flow investing, he shares how you can do the same through cash flow investing strategies. MC is also the founder of Cashflow Ninja and the creator and host of the top-rated business and investing podcast, Cashflow Ninja, which has been downloaded millions of times in over 180 countries. MC is also the president at Producers Wealth, a wealth firm that assists investors and business owners to implement advanced cash flow strategies. And MC is the principal at Producers Capital Partners, an investment firm that helps investors to invest in alternative cash flow investments. MC, my friend, good to see you.
Great to see you. I've been looking forward to this conversation.
100%. Me as well. I think investors had a chance in the audience to listen to you. If you haven't, we had a great interview back at episode 6. So please go back and listen to that, which has a full background of MC's story and everything. But just as a quick kind of summary of your background, which is really fascinating as to how you really got into the space, how you've evolved, and I think your kind of global and macro view on economics, politics, and cash flow. That'd be a great place to start.
Yeah, absolutely. I grew up in South Africa during a very, very interesting time. So as a young man, I saw, the world in front of you just flip upside down, right? And I realized that, during that time, that there's a lot of things that I wasn't aware of and that I should become aware of, because I even saw adults as a young man completely couldn't make sense of what was happening. I also grew up on a homestead in South Africa, would be qualified as a homestead, which is a huge advantage in the investment world, believe it or not. I started to realize it become quite a strength because you know how things work and where things come from and how everything is connected. If you don't plant your seeds at a certain time of the year and you don't nurture it and take care of it and manage it well and properly, well, there's not going to be anything to harvest, during harvest season. So coming to the United States, I played at a very high level sports here. And as I was traveling, I was just, reading history and economic books. That was kind of my passion. And that was my major in university. And I started to read Rich Dad, Poor Dad, which led me to discovering this incredible cash flow investing. Took action, bought my first investment property. And after collecting all of the rent and paying all of the fees associated with it and expenses, it cash flowed. So the light bulb moment was, wow, this can work. I read it in a book. My paradigm shifted, my thinking shifted. I took action, I implemented and executed. And now, wow, this property is cash flowing. How many times can I do it? So I became pretty passionate about cash flow investing. But as an investor, I've always tried to educate myself of what's going on, because I've realized how connected everything is, and especially the global economy on a macro level. So I became a student of macro economics, and also I try to sharpen some of my technical skills of being part of trader communities. I don't trade personally. I don't have any I don't own any equities, but I felt like as a well-rounded investor, this is a skill set of how you can identify things on a shorter term kind of time frame. So so as my cash flow journey evolved and grew, There was lots of lessons. There was a lot of great times and success. There was a lot of challenges and obviously failures, which helps you grow as an investor and also as an entrepreneur. I discovered this strategy, this advanced cash flow management strategy. And this was as early on as a real estate investor. I had a friend that came from a very wealthy family, and they operated their own family office kind of structure. And I realized how cash flow was managed within their family office structure was completely different than what anybody else was aware of. And this is where I discovered infinite banking and brought that into what I was doing, which really just amplified and just put a little bit of rocket fuel on my real estate investing. So in 2014, around 2014, beginning of 2015, I started Producers Wealth to help other investors implement and execute the infinite banking strategy too. There was a huge disconnect in financial services between the business owners and investors and actually the providers of it. And as an entrepreneur, when you see a disconnect or you see a gap in the marketplace, well, there's an opportunity to provide a solution and start a business. So I did that. And we're still active in 50 states in the United States, helping all business owner and investors implement and execute infinite banking. And then with Cashflow Ninja, my journey of learning continues. It's great. I learn from the best minds in business and investing on a weekly basis, doing a podcast. And the podcast has turned into a full-fledged education company where we have a book, The 21 Best Cashflow Niches, sharing the best niches that folks share on the show. We also have a newsletter where we share every single month a new cash flow niche that was shared, and also have a mastermind. But it's been a fun ride, Dave, and it continues to be a lot of fun meeting incredible people and getting to work with a lot of incredible business owners and investors.
Yeah, no, I really appreciate your wisdom and insights, MC. I think it is a really unique perspective, having that global view and being, brought up outside of the country, coming to the US and really understanding, the merits of what this country stands for, right? Which at the fabric of it, it's really all about freedom. Right. And as an entrepreneur, right, you're trying to seek freedom in your life. Right. And I think wealth and having money and the financial means to do things is part of really achieving that freedom. So, I think that's a really unique, look at things. And I think a lot of the audience can learn a lot from you in terms of how, you see the world. And segueing really from that as well is I love that you're able to, study history, always look at becoming a better investor, and you're really understanding everything at a macro level of kind of what's going on in the world, right? Geopolitically, politically, economically, there's so many different sources out there. And I think it makes it very confusing for investors to say, how do I make the right decisions, right? What is best for me in terms of allocating capital, in terms of building wealth? And especially right now, we're in this environment where, everyone is pushing fear is basically what people are doing, right? There's a lot of fear, and that can be, very scary. It can put you in the mode of, being, paralyzed, right? And the deer in the headlights and not actually doing anything. Or it can make you irrational, right? And you make an emotional decision, right? And that's where investors always lose, when they tie in the emotion. So I think it's great to create really a system and a strategy around your wealth. But talk to us a little bit about, just from kind of a macro perspective, we've got, a lot of failures in the banking system right now is one thing that's really prevalent. But can you give us kind of your 30,000-foot view of how you're kind of seeing the world view, the economy right now in 2023?
Absolutely. And to your point, I think one of the things that I learned as a young man in South Africa was that there was a lot of uncertainty. And I've already, and this is, I feel that the gift that I received early in my life is there was so much uncertainty. Nobody knew what was going on, which then, the herd mentality kicks in. So if there's so much uncertainty, then obviously fear starts, it becomes hysteria, and it's a very chaotic environment. And having already lived through that, I can see that the folks that have great frameworks and models of how things work and how the world works, they don't get sucked into every single issue and become emotional about it. They just stay focused. They're going to have a huge competitive advantage. And also from an information standpoint, you have to, as an investor, read everything and wide, right? So I look at, like what's going on in the mainstream media, and that kind of gives me an idea what the official narrative is, right? And then I read opposing views, and then I read opposing views of people around the world. So that kind of makes you see things from different angles, and it gives you a better picture of what's actually going on. So on a big macro level, there's been a world order in place with the US at the forefront and the US dollar as the world reserve currency. And that's how the world is operated coming out of the Second World War, right? So in 1944, Bretton Woods Agreement was put in place. The United States dollar was put in as the world reserve currency. The US came out of that war as an established superpower, really unchallenged, because the Soviet Union at that point, they were badly bruised from the war, and the U.S. was a huge producer and creator of goods, which made its way to the war front in Europe, and a lot of capital came back to the U.S. and made the U.S. very, very wealthy. And this is all cyclical. So now, at the point we were at right now, so globally, there is a lot of different themes, and I mean, we could talk about that for hours. But the one thing that I want to drive home is that the world order is slightly changing. Now, it's not in one way or another, it's still figuring itself out. And you're going to start to see a lot of different moves made by different countries, not just on the war front. Most people think, this war theme that's going around, there's a war coming. Well, wars are very, very different than what the average person perceive them to be. They can be economic, they can be financial, they can be psychological, and eventually, we think of war as the kinetic form of that. So there's already been, there's always psychological, financial, and economic warfare going on. That's kind of how the balance in the world order is established, right? So this has been going on, and it's just been taken to another level. Now, how does the other theme that you refer to is the banking crisis. And this is very, very interesting because of the world order that was established. The US dollar was the world reserve currency, and the world's monetary system is a debt-based monetary system. So it has been. So because of all those things changing, and especially in the system in the way that it is, this has impacted a lot of the centers of finance where banks are at the middle. So, for example, because it's a debt-based monetary system, you can see every single country just creates more and more debt, right? And debt just keeps increasing. It's the very nature of the system. So the system depends on it. And over the last couple of years, interest rates dropped really, really low. Really, really low all over the world. We've heard the terms free money and cheap money and, low rates and so forth. And people might have seen their mortgages that they could have locked in at one stage for under 3% if they were fortunate to. Well, this has had the result to a lot of exuberance, a lot of asset prices being inflated, and inflation, which has become a huge political problem, not just in the United States, all across the world. So central banks across the world then started raising rates. Now back to the banks. Well, where do banks put a lot of their capital and warehouse a lot of their capital in that they use as collateral? Well, you and I will chuckle at this, but a lot of quote unquote risk-free assets for collateral is bonds, government bonds. So a lot of banks, like for example, Silicon Valley Bank, and you had Signature Bank, and even Silvergate Bank, they had a lot of bonds, which they bought at a very low interest rates. Now, when interest rates double in almost 6 months, that the value of the collateral which the banks have. Now, that's one thing if a bank can hold a bond to maturity and collect the full amount. But when they cannot do that, Well, they have to sell the bond at a loss when depositors actually want capital. And that's what happened with those three banks, and specifically Silicon Valley Bank, where there was essentially a run on the bank for many different reasons, and they had to sell it at a loss. And it resulted in other banks, which was in business with Silicon Valley Bank, to sell their collateral too. So all of a sudden, they were all insolvent. And then it kind of turns out that a lot of the banks were in the exact same situation. And now there's fear, there's panic, there's hysteria, there's a run on certain banks now. And this is kind of where a lot of banks have found themselves to be insolvent. So what I see happening in the banking industry is that, at the end of last year already, if you look at, there's 4,800 banking licenses in the United States currently. And there is, and I've had conversations with insiders in the banking industry, where there were banks already by the end of last year, over 700 banks that were technically insolvent. So this, the insiders already knew that a lot of this was coming in this year. And that, of course, when the first three banks went under, there's now a contagion, and we saw First Republic Bank go under. So, and the hearings that has been held so far, and questions that have been asked to the FDIC, to the Secretary of the Treasury, Janet Yellen, has not produced confidence at all. I know they're coming out and saying the banking system is sound and resilient. We've had the president come out and say that. We've had Jerome Powell from the Federal Reserve came out and say that. When everybody comes out and say that, there's panic behind the scenes. So what's happening? Janet Yellen went on to Capitol Hill. She was questioned by a senator. I believe it was from Oklahoma. And he asked her point blank, look, we have smaller banks, we have regional banks. Are the deposits in those smaller and regional banks, will they be even the uninsurable accounts, or the amounts over the insured amounts as put aside by the FDIC and insured by the FDIC, will they be protected, as in the case of Silicon Valley Bank? And a response was, well, they're not insured. And he then said, well, so you're telling me that Silicon Valley Bank was their depositors were being made whole. Side note, there's a lot of politically connected people that bank with Silicon Valley Bank, but the other depositors wouldn't. And she said, they're not insured. And he said, do you understand that now smaller banks and regional banks, the deposits will move from these banks into larger banks? And she said, well, we certainly wouldn't want that to happen. That is exactly what's happening. So since that meeting, so for folks, the big takeaway, if you're wondering what's happening in the banks, is deposits are fleeing smaller and regional banks, and they're going to bigger banks because people are now afraid that all these smaller and regional banks are the next to fall. So you're going to see a lot of the smaller banks disappear and go insolvent. You're going to see bigger and medium banks and regional banks disappear and go insolvent. And this is going to continue as deposits flee. And there's nobody's doing anything to stop it at this point. So that's what's kind of happening there, and it's going to play out very, very interesting. It's the one thing that investors should know, and this is kind of like, I jokingly said I grew up on a homestead. So I figured that everything is connected. I know where eggs came from. I know where the chicken wings came from. I know where milk and butter and all those things came from. If you think about like how things work in the banking world, well, who are some of the biggest lenders to small businesses and smaller investors? Well, it's smaller and regional banks. So investors are going to be affected by that because most of the lending is done by the smaller and regional banks. So it's definitely going to have an impact on small businesses, smaller investors. It's going to have a profound impact in the economy. So it's going to, again, we're seeing what's coming from a kind of a macro perspective and looking at what's happening inside there. So there's not, I would say, it's important to know this is happening. And it's also important to know that there's things that you can do to protect yourself from any of the chaos that's happening in the banking system.
Yeah, that's such a great backdrop. And I know that we are aligned in terms of, how we share our viewpoints, right? Because, again, a lot of the things you hear in the media, mainstream, there's always agendas hidden beneath. right? And everyone is trying to, push you to think a certain way. So one of the things, we're trying to do is really objectively look at what's going on, right, with these different types of things. And then also figure out, okay, how can we help the investor make better decisions, right, about
Yep.
allocating portfolio, about insulating themselves, whatever it might be. So just, remove the emotion from the situation, and then let's try to figure out, where are we going, right? Where do we want to be? So it's kind of taking that uncertainty and creating certainty with it.
Yep.
So I think for people out there, if you're concerned about your bank, right, there's multiple things that you could do to actually, redeploy that capital. Also, from an overall economic standpoint, what could you do with all of this certainty, right? Well, the
Yep.
way I like to think about it is, okay, well, if you lost your source of income, whether you're a business owner or W-2, whatever, are you going to be impacted? Do you have enough runway, right, to get you through this until you can figure out the next thing? So whatever that might be for you, maybe 6 months, maybe 18 months. I know family offices, ultra high net worth, they actually have like 3 years of liquid capital to move through an entire cycle, right, of
Yep.
liquidity, right? So I think a lot of this is around how do you actually manage your liquidity, right? And no one really kind of talks about that, right?
Yep.
From a portfolio standpoint, how, what is the best way to manage liquidity? And as you discovered, we came into infinite banking, myself and my wife 10 years ago, and found the merits of that. And I wish actually I had known that even, 20 years ago, because one of my inflection points was having a pretty significant crisis in my business, and I had all my eggs in one basket. Right, I wasn't
Yep.
diversified enough, and I didn't have that liquidity to kind of get us through. So it caused us to scramble and everything. So, what can you share with the audience about trying to create certainty about uncertainty, and how does that tie into some of your cash flow strategies with infinite banking and others?
Yeah, and I think what folks should be thinking about, and you really stated it very, very well, is where do you warehouse liquidity? Because if you're listening to this and you're a business owner and an investor, you do need access to operating capital, right? So you have to have some sort of a diversification strategy in place with regards to warehousing capital. It could be a couple of banks and different accounts. It could be some credit unions, but I would definitely, because you need in some cases 3 to 6 months at least of just operating capital in a bank. So that's one thing that I would highly encourage folks to think about. Don't have all of your eggs in one basket. There was a lot of folks in our network that had everything, all of their money in First Republic, in one bank. So they were very, very nervous. And again, this brings in a lot of anxiety, a lot of fear, and so forth, and just distracts you, takes you away from your business and your investments. So if you have some diversification strategy in place, just from an operating standpoint, that's already going to serve you very, very well. And then, with the infinite banking concept, and this is using mutual insurance carriers as a vehicle, and more specifically, a life insurance policy, a dividend paying whole life insurance policy with a mutual insurance carrier as a place to warehouse large amounts of cash. Now, one theme that I spoke about ad nauseum last year was counterparty risk. And I said that one of the biggest lessons that investors are going to learn, they're either going to learn it now and listen to me speak about it ad nauseum, or they're going to learn the hard way in the next coming months and next coming years, is what counterparty risk is. And that is, counterparty is the other party on the opposite side of a transaction that has to make good on contracts. So for example, when you put your money in a bank, the bank is a counterparty to your capital. If they don't allow you to access your capital, if they default on, let's just say, their contractual obligations, then you're going to lose your capital. And of course, there's a lot of different things in place with banks, right, that people should know about. When you put your money in a bank, it's no longer your money legally. Those are already on the books. That's why folks said, how can bail-ins be legal? Well, that's already legislated after the last crisis. It's all over the world, not just in the United States. It's also not there because of the fractional reserve banking model. You should know about this in analyzing a counterparty. When you look at where to position capital, look at the counterparty risks and do your research of each and every single one of them. So when I look at other places where you could warehouse cash, I've mentioned banks. How about bonds? Well, there's counterparties there. Bond is a debt instrument. The issuer of the bond is the counterparty by definition. So if you have municipal bonds, if you have even state-specific type bonds, if you have federal bonds, let's just say U.S. Treasuries, which a lot of folks do, the counterparty is the government entity on the other side of it. So there's a default risk. There's also, the risk there too, of course, is the interest rate risk, which we don't have a lot of control over. We don't have a lot of control what the Federal Reserve is going to do. And what the market's going to determine that way. So look at different risks. So mutual insurance companies, when I look at counterparty risk, they've been around since the mid-1800s. They have been profitable and kept their promises every single year since the mid-1800s. And I look at, from a historical perspective, an economic perspective, like what storms have these carriers weathered? Well, if you're in the United States and you're a mutual insurance, life insurance carrier, you experienced the Civil War, the U.S. Civil War, where there were literally, most people are unaware of this, there was two types of currency circulating in the United States. You had greenbacks and graybacks, and they still provide a profit during that time of massive uncertainty, chaos, disruption, panic, and of course, hysteria. Then you go into the creation of the Federal Reserve in 1913. You look at World War I, World War II. You look at recessions, market crashes, the Great Depression. All of these things I went through. So, when I analyze counterparty risk too, it's, how are people going to behave in the future? Well, that's a very tough one to predict, but there's a very high probability that people and institutions and organizations will behave in the future as they have behaved in the past. So that's why we look at from where do we warehouse it? And, with infinite banking, what it is for folks that have never have never heard this term before, or this is your first time of hearing of this strategy, you use a very specifically designed life insurance policy. This is how they design it in family offices, and it's designed to increase the cash value, not just for the death benefit. Most people think life insurance, is actually death insurance. Somebody has to die in order for someone else to benefit. You're using the vehicle of life insurance, and it's specifically tailored and structured so it becomes a vehicle of where you can warehouse capital, and with guaranteed growth in the policy, tax-free growth, by the way, too. The dividends that you will earn in the policy is, and it's not guaranteed, but these companies have paid them since the mid-1800s. So there's guarantees, tax-free growth, tax-free access. The dividends are tax-free. And then, of course, from a wealth preservation standpoint, and this is why the folks might have heard of the Rockefeller family banking strategy, where they've used these life insurance contracts because the death benefit is also tax-free, and it goes tax-free to the beneficiary, whether it be a trust or whether it be a spouse or whether it be children. So this has become a great vehicle to warehouse cash because it's outside of the banking system. I saw last year, I'd mentioned this to you actually in previous conversations. I saw last year so much capital flight from family offices with some of my colleagues that I'm friends with in there, saw how a ton of capital went out to banks into these life insurance contracts at the end of last year. And, full disclosure, I set up another policy for myself last year too, because I went through this exact same exercise of where would I sleep well to warehouse cash. And I just came back after going through looking at banks, looking at bonds, looking at 401ks and IRAs, which completely takes control away from you over your capital. I couldn't find a better place. So when the crisis started hitting, a lot of folks in our network just kind of smirked and smiled, because the majority of their bulk of actually their cash reserves were outside of the banking system in these life insurance contracts with mutual insurance companies.
Yeah, great point. And can you also comment on you had mentioned the other day, which I found really interesting. You were in a group with some of the executive teams of one of the large mutual insurance companies that was talking about record inflows into life insurance in the past 2 years.
There's been, so the executives in a lot of these mutual insurance carriers, they've seen it too, where a lot of folks, the smart money has realized, where do we need to go to position capital where it can be protected from a storm, regardless of what that storm is, and so that we can eventually access it to capitalize on opportunities. So these companies have had record profits in the since 2020, and they continue to have record profits because it's become a safe haven to warehouse capital effectively and efficiently. And if you look at, even where banks themselves buy these exact same life insurance policies, bank-owned life insurance, there's only a certain amount of their tier 1 capital that they can put in there. Corporations use this. It's called corporate-owned life insurance, so BOLI and COLI. And then, of course, family offices and so forth. So, the insiders and the smart money knows where to warehouse it. So if you look at what, banks and corporations, and you look at what family offices are doing, very wealthy individuals and so forth, where they're warehousing capital, this has become a place for them, and they're seeing it. For folks, and this is very interesting too, from some of the meetings and insights that I've had with these carriers, they have billions of dollars of excess cash reserves. So over the amount even that what they need to pay out death benefits. So they're very, very financially strong. They're very sound. Mutual insurance companies too. This is also, I think, an interesting little tidbit, which I found very interesting, is their mindset. They think in terms of, 50, 100 plus years. One of the things that I learned is interest rates doubled, like literally in, like, I think it was a period of almost like 6 months, or maybe a little bit more, but round about there. These mutual insurance carriers don't have to make sudden movements to adapt to that, because they have a very long runway, and they manage their organizations, their companies on behalf of the policyholders. So they don't have to make any sudden movements to make their stock appetizing for Wall Street and all of the Wall Street media to promote it. They can do what is in the best interest for their policyholders, so they can, wait another 12 to 18 months, see if this is a trend, see what's happening, and then make adjustments. And that's why they've been in business so long. Try to find a company that's been listed on the stock exchanges. How many of them are over 100 years old, right? And have been profitable for 100 years consecutively. So it's a little bit of a different mindset.
Yeah, for sure. And so when I started this journey myself, probably about 10 years ago, and I had first heard about this concept, and again, studying the ultra wealthy and figuring out how they're managing liquidity and warehousing capital, I learned about this strategy, but I found that there was so much confusion in the marketplace. If you talk to your financial planner who might have a life insurance division, right? If he's a larger organization, or you call in and talk to different people. So why do you think there's so much confusion in the marketplace in terms of carriers who can actually provide the vehicle to support this? As well as why is there a misunderstanding in the marketplace of the infinite banking concept versus a cash value life insurance policy?
Yeah, there's a lot of confusion, and it's also one way that I look at it is, if you look at the financial world, there's different incentives, right? So with the asset under management kind of incentive is what drives most of financial services, which this is not a product or a vehicle where the financial professional has that incentive of asset under management. So I found too that, in my journey, when I saw a huge disconnect between financial services and business owners and investors, I saw that, the best place for a business owner and an investor to keep their capital is where they can access it to grow their business and their investment portfolio. That is the best place to warehouse it, where the incentives in the financial world is, well, no, your best place is give me your capital and I'll invest it for you in a diversified portfolio of stocks, bonds, and mutual funds. Investing in other people's businesses and ventures, right? Which is kind of crazy if you look at it that way. You should put it in a place outside of the banking system with guarantees, within a tax-free bucket where you can access it through policy loans or life insurance lines of credits to grow your business and your investments. And I would say, the confusion in the marketplace is, and this is where you get a lot of different commentators with such strong opinions, which is kind of funny, right? Most topics in life, people don't have strong opinions. Pit bulls and life insurance, very strong opinions. Very, very strong opinions. It's just the way that life insurance itself is a very, very misunderstood asset class. And there's different levels of strategies. So you have your very basic retail strategy. And that is how the majority of the public, unfortunately, buy life insurance. I would say 99% of the public just buy retail kind of life insurance. They're going to overpay for it. It's not going to be effective and efficiently. Some of it, you could have some products that could fit the need, like a good, solid term or a convertible term policy for a while. But that's about it. You have and most folks don't talk about the advanced kind of life insurance strategies that does exist, right? So I'll give you an example. So we have commentators, everybody's favorite financial commentator, Dave Ramsey, that talks about and bashes life insurance all the time. And a lot of the stuff that he says are great points when you look at how retail life insurance are sold. But what Dave then fails to the question to ask himself or his audience is, well, if this is so bad, and I'm just laying out all the points and bullet points why this is so bad, why do banks, corporations, family offices, and very wealthy individuals buy as much life insurance as life insurance carriers would sell them? Because there's a different type of strategy. It's an advanced strategy. It's a warehousing strategy. And then obviously, we talk about a lot of different advanced kind of life insurance strategies from a cash flow management perspective, from a legacy planning perspective, and then also where you get to leverage, third-party capital to actually fund life insurance strategies creatively through premium financing. But I think that's why there's so much misinformation. It's very misunderstood because the industry itself is there's just so many, there's so much noise just on the retail kind of sales side of it. And there's not a lot of information about advanced planning when it comes to life insurance.
Yeah, no, appreciate that clarification. I think it's really important to objectively look at these things. And what would you say around, from capital allocation, right? If someone was looking at a policy, what's really the best, perspective you could give them in terms of, do I set this up and, pay it over time for the next 20 years, the next 5 years, or maybe I have a liquidity event, or what's, a comfortable number or process they should look at?
That's a very good question because everybody's in a different situation, right? And this is very, very customizable. So we're creating a custom strategy specifically tailored for every single individual. There's no one size fits all. There's no cookie cutter kind of planning in the advanced planning space. So we will see, what liquidity you have that you would want to move to safety. Like I shared right now, a good rule of thumb is if you have 3 to 6 months of operating capital for your business, you should probably then look at positioning all other capital in different areas. and look at moving it into a place with guarantees. So yeah, there are some folks that come into liquidity events, whether it be inheritances, whether it be businesses that they sell, whether it be investments that they sell. There are strategies that you can quickly fund a policy within 5 years, fully funded, completely funded, paid up. There's no more funding needed. Then there's 10 pays where folks, let's just say, want to pay a certain amount of their capital into policies for 10 years, and 20 years. And then there's folks that want to continue to pay into that with flexibility of when they can stop. So we could do that too. So yeah, the other thing I think that people should know about, if you have a 401k or an IRA, for example, one of the biggest threats, the biggest threat that we talk about in our network quite a bit is taxes in the future. So if you have money in qualified plans and you're over 59 and a half, you can take money strategically with the help of a tax professional out of those plans, fund these policies, and create a bucket that produces a tax-free retirement for you, income stream. So you can do that too. I think that's one thing that I didn't touch on earlier when it comes to some of the things that people do. It produces a tax-free income stream for you for retirement or to supplement retirement in the later years. So if you have assets that are allocated in buckets that are taxable and that are subject to market forces, you want to look at diversifying and at least putting capital in a different place where it's protected from market forces and taxes. Because as I mentioned, this banking crisis that have started, it's going to continue. It's a contagion that's going to spread. It's going to pick up steam. And eventually this is going to lead to a bigger and bigger banking crisis, which could then go into the financial markets. Now, there's a very high probability if I look at the world right now to play that out. So you don't have to be a victim of that. You can see this coming a mile away. You can take necessary precaution, diversify your liquidity in banks, diversify your liquidity into things like the infinite banking strategy in a mutual insurance company that has a life insurance policy with guarantees and tax-free growth, so that you have capital to capitalize on opportunities. Because with all the chaos that I think that's coming, there's going to be so much opportunities for folks.
Yeah, I think we could do another episode on this, MC, because I'd love to talk some specific use cases, because I've seen examples of how people are using this in their overall strategy, which is really, really powerful. And, the other thing we talk to with folks is that this is really a process, right? Infinite banking is a process. And if you've read Nash's book, you understand, that you have to work on that process. You have to work on that in your wealth strategy, right, to get maximum advantage of it. And I think we're constantly inundated with just thinking that, one product is going to be the solution for something. Right? Okay. You might have the vehicle to do something, but you need to understand the process, how it works, to be able to maximize it. So, I think the next time you come in, it'd be great to, walk through some specific use cases of how people are actually leveraging that. And then one other just quick question I wanted to ask in terms of like an age. So you're talking about, 401k at 59 and a half. Is there a certain point where this becomes too cost prohibitive based upon your age?
That's a great question. And just a comment on Nelson's book, where he talks about becoming your own banker. And he says, he's the discoverer of the infinite banking concept, and he talks about unlocking and becoming, these are all process words. And he was a stickler for words. That's why it's becoming your own banker, not become. It's not a one-off thing. You just put a policy up and that's it. And unlocking the secrets of the infinite banking concept, because you keep unlocking them and you keep learning and you keep growing. And this is part of your overall holistic wealth strategy. When it comes to age, we've even had policies for folks in their late 60s, which made sense. Every situation's different. But we've seen that. And then, of course, when folks are in their late 60s and 70s, there's children, there's grandchildren. You can really set up a family legacy and a family bank, which is something that I'm very, very passionate about and talking about, because you can really change the trajectory of the financial future for your entire family by structuring and setting this up correctly. So you can be the person that was the person that changed the entire trajectory just by establishing the strategy and establishing a structure for future generations to implement and execute.
Excellent. And if you could give just one piece of advice to listeners about how they could really accelerate their wealth trajectory, what would it be?
I think that it's as an investor, it's realizing and recognizing cycles. Folks, somebody asked me the other day, do you believe in cycles, MC? I said, well, last night the sun went under and this morning the sun came back up. And, we just had winter and we're into spring, and summer's coming pretty soon. So the world operates on cycles, and so does the financial world too. So I think the one thing that I would share with folks is recognize where you are in economic and financial cycles, and then invest accordingly. There's different strategies at different parts of the cycle. So, there are times in a cycle where that's the time to deploy as much capital as you possibly can. Then there are other parts of the cycle where this is now your build up as much capital as you possibly can, because pretty soon you'll be able to use that. If you were in 2007 and 2008 in a capital allocation mode and set up and position capital where you could access it later, you would be in a fantastic position to capitalize on opportunities that became available. Really, if you think about it, the bottom was around 2011, 2012. But you would have had like 3 or 4 years of just capital allocation and accumulation that you can now deploy and buy at rock bottom prices, and then keep buying up, up into the cycle. So I think, that's one thing that I would share with folks is it's a great time to set up good, proper legal structures, whether it's asset protection, estate planning. It's a great time to set up infinite banking policies, to warehouse capital, so that, when the chaos arrives, which we could see coming from a mile away, that you're not going to be that affected by it, and you're going to be in a position of strength to capitalize on opportunities.
Really appreciate those insights and everything that you've provided today. I think it's been super valuable and really, really relevant to the times that we're in. So thanks again for your time, MC. Always appreciate the wisdom. Always learning from you as well, and getting together. It's grateful for the opportunity. And if people want to reach out, learn a little bit more about what you're doing at Producers Wealth or anywhere else, what's the best place?
Yeah, so Cashflow Ninja is just where the education things are with regards to cash flow investing. As folks are interested about infinite banking, just go to yourownbankingsystem.com. There's a video up there about 30 minutes where we explain the entire strategy. We give you examples, we give you case studies and more, and it's all done. I think it's around 30 minutes. So that's how folks can learn more and get in touch.
Awesome. Thanks so much for coming on the show, MC.
Thank you so much for having me.
You bet.